because at the time when I was trying to learn, there wasn't really much out there for me. So I'm just going to be very upfront, put it all out there. So listen up. When you use trading as a tool to make money, you need to understand that it's a zero sum game, meaning everyone is on the other side of the trade. That means that when you're making money, someone's losing money, so on and so forth. So, what does that mean? That means that you need to start doing things to position yourself on the money making side and not on the money giving side. Does that make sense? How do you do that? Well, listen, when you start to trade, you start to look at the 1 minute time frame thinking that this will make you millions. But the reality is, when starting out, there's too much BS that goes down on the 1 minute time frame that takes you away from the higher time frame picture. So without that picture, you pretty much won't be able to actually execute correctly. Let me make myself a little bit clear here. Without using higher time frames to build your bias, you will always lose money. If you do not understand where the market's going overall, the 1 minute retraces will actually be extensions, and the 1 minute extensions looking things will actually be retraces, and you won't know where you are. So, to locate in which phase of the market you are, you need to understand where the market's going. Does that make sense? Okay. So, how do we do that? My strategy is plain and simple. What we do is very simple. We go down to the time frames and identify what the direction of each time frame is. We want all the time frames to align, and then we just want price to be balanced. If price is balanced and the time frames are aligning, odds are market's going to drift in the higher time frame direction. So if we know where it's going and every time frame is saying that it's going in that direction, we just want to hop on the train. If it's not going in that direction and it's facing a pullback, we want to see where it's going to pull back to. But either ways, we are just trying to get the market drift. Okay? Daily time frame on gold for us to execute this trade today was bullish. As you can tell, this is the nearest daily high that has yet to be taken. But I just marked this out so that I could take profit here because I didn't want to hold all the way till there considering my entry and my risk to reward. So we know that daily time frame is bullish, going up, down, up, down, up, down. So in our head, gold will likely continue higher in the long run, or at least on the daily time frame. Now we scale down a little bit so that we can understand the lower time frame narratives, right? So we scale down to the 4 hour. Does that make sense? Yes. There we go. So let this load. I don't know why it's taking so long. The new Wi-Fi people came to my place and said that they fixed it, but clearly they didn't. But what we're going to be doing after this is going from the daily time frame and validating that, saying, okay, we're bullish. We're going to go down to the 4 hour time frame. We're going to say, okay, is that bullish? There we go. I don't know how this is this slow, but the 4 hour time frame is also bullish. If you saw my trade yesterday, I was bullish, but I did get stopped out on one or two entries. Well, one really, and then the other one hit for a 2 hour. But here, we mitigated the gap and we continued on higher. So the 4 hour is balanced, as you can tell. So price really doesn't have much reason to not extend yet. Now we scale down one more time again to the hourly time frame. So we can say, okay, the 4 hour time frame is going up. It retraced. Now we're going back up. So we want to just ride this wave, right? So this is our market open, but we want to look at what happened before. See, the hourly expanded, retraced, expanded, retraced, right? Now we get another extension and then another retrace, right? So the hourly time frame is what? Bullish. Look at the structure. Most recent break of structure was to the upside. So we have an hourly break of structure, and hourly is currently bullish. So the hourly time frame is bullish. The 4 hour time frame is bullish. We mitigated a perfect balancing of price to a 50%, right? Now we know that the 4 hour is bullish, the daily is bullish, the 1 hour is bullish. Now we want to scale down even further so that we can say that all time frames are aligning for price to go what? Higher. We go down to the 15-minute. So what can we tell here? The 15-minute is bearish. So you won't usually get all the time frames that line up. So how do you continue about this? Because we know that even though the 15 minutes bearish, everything else on the higher time frame is painting a bullish picture. It's not like the 15-minute holds more power over the daily 4 hour and 1 hour time frame. It's actually the opposite. The daily 4 hour and 1 hour time frame hold more power against the 15-minute. So the 15-minute will flip in structure and go in the original higher time frame direction. Does that make sense? Yes, it's not that hard. As long as you know what a break of structure is, all of this is easy. So we said that the 15-minute is bearish coming into market open, which was at 8 a.m., right? So what can that tell us? Very simple. We need to invalidate the structure that was made on the 15-minute. How can we tell that the 15-minute is about to reverse? A 5-minute reversal. There we go. So what's a key point here? 15-minute fair value gap. These are all concepts that you can learn to make everything better and just add confluences. But really, you can just use a break of structure and equilibrium and you're already going to be profitable. We get what? A 5-minute liquidity sweep, also another concept. You really don't fully need it. What you just need to understand is where the market's headed. So we get a 5-minute break of structure, right? What do we see? We see a retrace. But what happens? The 5-minute structure is still remaining bullish. So people will say, oh, this looks bearish. It's a trend. No, structure has flipped. So we are in a bullish market state. Got it? So now we have the 5-minute that's bullish. That's going to tell us that the 15-minute is about to change. The 1 hour is bullish. The 15 is about to change, like I just said before. The 4 hour is bullish. The daily is bullish. Now we just need to execute on the lower time frame because the 5-minute just went bullish and the 15 is going to change. Let's just find an execution point. So what does that look like? We scale down and we wait for a 1-minute break of structure. Not that hard. There you go. It's that simple. Well, okay. Preface, I didn't use that to execute today. What I used is a little bit different, but I would have used that had I wanted to. It's just that there was better risk to reward by trading the invalidation of the bear structure. But you can even put that to the side. You could have executed up top here. You could have executed here. Anywhere within here would have worked fine. So what happens? We get the extension that causes the 5-minute break of structure, right? But we know that we don't trade before market opens. That's a rule. So market opens, we wait it out, we see the first few candles. We know that this is just making the hourly low because you see those candles that come up. For an hourly candle to look like this is unrealistic. It'll likely look something like this one right here. It makes a low and then it also expands. Does that make sense? So this was the making of that low for the expansion to come. Make sense? You always have to picture the higher time frame narrative. And here, what did I execute off of? Well, I executed off of the invalidation of this bearish fair value gap. When I saw that, I knew that I was pretty much good to go. And that's just because if you scale down to like the same concept, to the 15-second or the 30-second, you'll see that the break of structures were happening and we had a break of structure here, a revisiting of that area, an expansion, comeback, expansion, and structure was flipping bullish. So the invalidation of the fair value gap was pretty much all I needed there to anticipate the 1-minute break so that I could get better risk to reward. And the rest is pretty much history. Take profit 1, take profit 2, and take profit 3 is all the way at that daily high that I showed you guys earlier. It's that simple. You don't have to make trading hard. All you have to do is understand where market goes and observe where you can execute and where the time frames align. Because think of it as a giant wave. If market's saying, oh, we're going up, we're going up, we're going up, and everything is agreeing, odds are that market will naturally drift higher because that's the overall direction. You see this? It's drifting higher. You just don't want to get caught up in these moves here, in these moves here. You just want to enter somewhere within here and just ride the wave. See, yesterday we got caught up in this. That's why we lost. Because you can get the direction right and still lose. But this is pretty much where we got caught up yesterday and the reason why we lost. But you get caught up here when structure starts to change and when time is there because it's time-based structure shifts at the right locations that lead to the giant extensions, right? So we pretty much saw the retrace and price pretty much just went on expanded. So if you guys found this useful, I'd be very happy for you guys to join my Discord. It's completely free. I'm just trying to help you guys out right now and just give as much value as possible. I mean, I don't know who's giving out sauce like this and making it this simple, but it really is this simple. So lock in, watch the other videos, and learn.